Right, welcome to summing up what we've learned in the monetary policy. Yeah, and we're going to introduce a few new topics too to wrap up what we've learned and also add a few more things around how monetary policy uh, is currently used. Yeah. So the key takeaway from this chapter is before the financial crisis in 2008 and also the recent COVID crisis, the monetary policy had converged to mainly inflation targeting, meaning focus on inflation long term to be 2%. Yeah. And recent crises have forced that mandate of the Federal Reserve to think about that again, because some of these tools become ineffective when we hit a zero lower bound, meaning you have the policy rate at 0%, you cannot go below, right? And so, what else did the Federal Reserve do in that scenario in 2008 and also during COVID crisis? That's the topic we'll also learn. And what we've seen already is in the past many chapters, what is the impact of monetary policy? If you look at impact on money demand and money supply and how that eventually feeds into the interest rate. Yeah. And we looked at short run impact, medium run impact in chapter 5 and 9. And then in chapter 6, we looked at the distinction between nominal versus real interest rate and also distinction between borrowing rate and the policy rate. Yeah. And how these rates change on the short run versus long run in the interest rates, and how is that monetary policy, where is it going to be impacting in chapter 14. And very important, chapter 16, we learn about expectations, yeah, as to how the impact of policy action, specifically monetary policy, has on expectation, and that has an impact on spending and overall output. We looked at the open economy for both goods and financial market and impact of monetary policy in that. And finally, different monetary policy regimes, fixed versus floating, flexible exchange rates, yeah? And what are the problems that policymakers have, both financial, both fiscal and monetary policy in chapter 21. So this chapter, let's look at why the monetary policy there was a need for it to evolve from purely inflation targeting. Yeah, what we see is that until 1980s, um, even before the inflation targeting evolved, right? Until 1980s, the strategy was to choose the target rate of money growth, meaning increase the money supply to allow for deviations from the target rate of the activity. So you would want to focus purely on money supply, and the rationale there was you would target a rate of money growth which is implied by low average rate of inflation, so about 2%, yeah, or less. So, but what we've seen through data is that the M1 money growth, or M1 is the money supply that is used as a proxy. Think about it as liquid money, or money that's like currency, checking account money, the demand money, or even post 2020, certain saving accounts are also part of M1. So this is money that's liquid, yeah. And what we see is that money supply and inflation, there is not a good tight enough relationship, because inflation started reducing and this was still up for more than 10 years. Yeah, M1 growth was still up. So focusing on M1 growth alone will not help focus and reduce inflation. Yeah. So reducing M1 growth didn't help us reduce inflation and so on. Yeah. So the tightness of relationship has reduced, and so this is the reason why we need to revisit the inflation targeting, right, as as more important than purely money targeting, like how much money is in the system that creates appropriate inflation, because that relationship is not holding, but rather go straight to what is the inflation that you're expecting and target that. Yeah. And so we can reuse what we've learned from chapter 8, the Phillips curve, yeah, which tells us the relationship between inflation, expected inflation, and difference between unemployment rate. So if we look at that, that will help us to, so we had the equation in chapter 8, which is pi t minus pi et equals minus alpha ut minus un, where this is the expected inflation, this is the inflation target. Then we have unemployment target in the natural rate of unemployment at time t, inflation at time t, sorry, and then unemployment, natural rate of unemployment. Yep. So we see this, the difference between current inflation, expected inflation is negative alpha times unemployment, difference between the unemployment today and unemployment at natural rate. What that implies is that if we assume that expected inflation is what pi star, right, meaning that's what we want to target. Let's say expected inflation is pi star, meaning pi star is the target inflation that we want. And Federal Reserve says the target inflation that they want is 2%. So let's assume this is 2%, yeah, or pi star, or expected inflation is equal to what the Federal Reserve wants, or pi star. You can rewrite this equation in terms of pi star. And so that gives us a very clear way to say, if I have to target pi star, meaning if the central bank is able to hit the inflation target of pi star, unemployment also will be at its natural rate, meaning ut will be equals un, yeah, when this is equal to the inflation is equal to the target, yeah. So this is very important, because think about this: if you can target inflation and thereby control unemployment, output automatically will be taken care of, right? Because if you have the right level of unemployment, which is equal to the natural rate, then all of a sudden you will have output that is optimal, and it will be the natural growth rate that the country would be experiencing, and the output will not be either too much expanding beyond or like bubble territory, and then not depressed into recession territory. Yeah, so output would be optimal, which is also called as optimal or at potential, which is also called as divine coincidence, meaning focus on inflation targeting that gets you unemployment targeting that gets you output at potential. Yeah, so you get unemployment equals to natural rate of unemployment, inflation equals to the target rate, and output equals the potential. So everything is good. Yeah, so that's where this relationship breakdown led us to focus on inflation targeting, yeah, instead of money growth targeting. Yeah. So the Taylor's rule also helps us, as we just derived, set the policy rate. Yeah. Uh, Pardon my animations, but I need to fix it. But in a sense, what we just did here, right? We can get inflation. Uh, so we can get the interest rate. Yeah. The interest rate that we need to set at time t is equal to the I star, which is equal to neutral rate of interest, right? Uh, and then pi star is the target inflation rate. So let's say from the target inflation rate that the Federal Reserve has shared is, let's say, 2%. So then we know what this is, yeah. And then we have the neutral rate of interest. Then that gives us I star. In a sense, we can look at the difference between inflation, current inflation, and the target inflation, and we look at unemployment, yeah, which is the current employment and the the natural rate of unemployment, yeah. So this equation gives us a way to set the interest rate or the federal funds rate or the policy rate, yeah. And so think about it this way: if we have I star, which we can calculate using the neutral rate of interest and the target that we have, and what we see is that if our inflation currently is equal to the target, meaning 2% is what we want and 2% is what it is, then we should set I interest rate is equal to I star, yeah, which is equal to this the nominal interest rate to be equal to I star. Yeah, so you don't need to go and change interest rate way further away from I star in that scenario. But if your inflation is currently higher than the target, then what you should do is you should set a higher interest rate compared to the I star target that we have. Yeah. So the current inflation that you would set would be higher than the I star value that you calculate here. Yeah? Similarly, if unemployment today is higher than the natural rate of unemployment, you would reduce, yeah, because interest rate as a function of unemployment is negative, yeah. So higher the unemployment rate, yeah, lower you would want the the interest rates primarily to boost the economic activity, yeah. So when inflation is higher than the target, when inflation is higher than the target, yeah, you would increase the policy rate, yeah, increase the policy rate um, above I star. But when inflation and vice versa, yeah, and vice versa, like and similarly vice versa here as well for unemployment. So think about it this way: we see from the Taylor's rule, right? This equation that we just derived, where we have inflation uh, that we have currently and in connection with unemployment. And similarly, what we just did is we looked at three different possibilities. And we know that um, we can use this rule that was, discovered by John Taylor, which tells us to look at the current inflation and look at the target inflation that we have. If it is higher than the target, then what you want to do is increase the interest rate above I star so that you can reduce the output, economic activity, and get inflation back in control. And the opposite for unemployment. Yeah. So this helps us set the policy rate. Yeah. So this Taylor rule is something that really helps us once we know what the target is. Yeah, once we know what the target is, and most central banks use the 2% target. And why is this 2%? Like, where does this 2% target come from? So look at this trend in the OECD countries from 1981 to 2019. And this chart consciously ends before COVID crisis because the trend is changing after 2020, which we'll also cover in this video. But the inflation OECD average was about 11% in 1981, and it just kept going down, 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 and close to 2% in 2019. Yeah, and so inflation rates were moderating, and we see that only 2 out of 24 countries had inflation below 5% in 1981, but 35 of 36 countries had inflation below 5%. Yeah, in 2019. And um, so the question again is like, should we use 2% or why not just get it down all the way to zero, right? Meaning that's the current debate. Should we have inflation close to 0%? Or even maybe higher. Why 2%? Maybe a higher 4% should be the target. Yeah, especially after 2020, what we saw is that we had persistent inflation, and we also hit the zero lower bound, and so we were stuck. And same thing happened in 2008, and so monetary policy becomes ineffective after hitting the zero. Conventional monetary policy becomes ineffective after hitting the zero lower bound. And so that's where this 2% or even slightly higher helps, because then you can reduce the nominal interest rate and then have boosting in the output that you can do. Yeah. But again, whether to have 2% or 4% or even 0% depends on the cost and benefit of having this inflation, above zero. So let's look at what are the costs and what are the benefits. Yeah. So the four main costs of inflation is shoot at the cost. If you have higher inflation, what you will do is you will not hold the money that you need um, with you. You would actually take and make a lot of trips to your bank and reduce your money balance as soon as you get it. And that is just unnecessary work because you are trying to get a little bit more interest. Yeah. And if you have higher interest, that you can get, you would reduce the money balance that you need. So that wears out your shoes as you make a lot of these trips. Today, you do this with a click of a button, but you understand that there's some effort gone here, that mental effort, time, energy that, that's unproductive for people to be focusing on these transaction related stuff versus focusing on creative new work. So the second cost is tax distortion. As people see higher and higher inflation, their asset values will go up. The nominal values is the value on which they are going to get taxed. So you bought a stock, let's say Microsoft, at $60 in 2014, and then you see it at 300 now. You're going to get taxed on the nominal current rate. It doesn't matter what the real value of that stock is, and you're not going to get taxed on the real. So you get getting pushed to higher and higher tax brackets as inflation goes up, and you'll start ending up paying more tax. And so you have distortion saying, what is my real purchasing power right now versus what it was 10 years ago? And so that distortion in your mind makes it uncertain for you to make decisions. And and it's also true that people, beyond, let's say, a low inflation number like 2%, it becomes hard for people to really calculate real versus nominal interest rate changes. Like, how is the purchasing power changing if there's a high inflation? And so this illusion has been validated through various studies where it's very hard for people to actually calculate this effectively. Yeah, so there's illusion of money. And finally, this if there's lots of uncertainty and variability in inflation, you don't really know if you buy a bond, let's say 10-year out, what is the because those payments are going to be in nominal terms. So what is the actual value you're getting, and how would you value it? So this variability of inflation causes a lot of this distortion, and in a sense also increases the risk of your investments into your financial assets. So these are some of the costs, and let's also look at some of the benefits. Yeah. So let's say you get a 3% raise. This person's got a 3% raise, but they don't know that in the news, the current inflation is 5%. So in a sense, they actually just lost 2%. So this is also a benefit because people prefer a 3% raise and a 5% inflation, which they don't think about, versus a minus 2% reduction in nominal wage. So that is equal to this scenario, but people prefer that. So this money illusion is actually helpful. The fact that people don't understand how to, calculate this, or they, go ahead and buy the 5% bond when the inflation rate is 6%, right? You're just losing money by doing this. Yes, you should instead buy inflation protected assets in inflation adjusted indexed funds that helps you protect against this inflation loss. Yeah. Also, there's a benefit if you have higher inflation. So I is equal to R plus pi. Remember, nominal interest rate is equal to real interest rate plus inflation. So if you have higher inflation, you will see real interest rates go down. And if inflation is way higher than the nominal interest rate, then you have negative real interest rates. So that helps you as a country to reduce your debt to GDP ratio, reduce your actual debt, because inflation is eating away at your debt. So, but at the same time, if you have um, positive inflation, then you can have an ability to, reduce your nominal interest rate to a much larger level, and because you have a way to change the nominal interest rates. Yeah. Um, at the same time, the probability of hitting a zero lower bound is higher, um, is decreased. The probability is decreased primarily because if you have higher interest rates, the nominal interest rates would be high. So zero lower bound becomes lower and lower chance. But if you did have the zero lower bound probability, that the 2008 event and the 2020 crisis, you can reduce the rate drastically, and that can help. But if you had low inflation target like 0%, then you don't really have a lot of room to reduce the nominal interest rate. Yeah. So these are the costs, the benefits. That's why the debate is going on as to what should be the ideal target. Is it 2%, 0%, 4%, right? Think about this. If there are no booms and busts, situation and things were, 0% inflation, meaning if I'm new 10 years out, what I'm going to buy now, my value purchasing power parity, not purchasing, my real purchasing power will remain the same, then it's easier. Or what I invest value right now, the value I'll get in real terms will be not eroded, then it makes it easier. But this is the trade-off. Yeah. So when we did hit the zero lower bound, the Federal Reserve went into this unconventional monetary policy, which is conventional monetary policy is about reducing nominal interest rate. Unconventional monetary policy is about doing something else because you can't do anything after the zero lower bound. So what the Federal Reserve did is they started buying um, securities, from the banks. They could start buying long-term treasuries, but also mortgage-based securities. Yeah, so they could start buying this from the banks, and when they bought it, they gave and injected liquidity. And what happened is that liquidity actually now all of a sudden you had a buyer of these assets. So now this impacts supply demand. There's a higher demand now of these assets. And when that happens, you start to see the risk premium reducing on these assets, which were uh, expecting much higher interest. Yeah. And so when the economy is in the zero lower bound, experiencing zero lower bound in the monetary policy side, you could impact the demand, and the Federal Reserve could be the demand generating entity, and all of a sudden you have risk premium reduced because there's a buyer available to buy it, and so at that market and make the market functional. And so what we saw is that during 2008, when the September 2008 Lehman Brothers files for bankruptcy, the first round of QE1 was announced in December, right after, within a few months, where they started buying long-term securities. Yeah, so they started buying long-term securities, but then also started buying in the second quantitative easing mortgage-based securities, and then also QE3, and then the balance sheet, the asset side of for the Federal Reserve went from less than $1 trillion to close to $4.4 trillion. Yeah, so and what that led to was also an increase in so if you see starting the same time frame, there's a lot of liquidity now being pumped into the banks, and so the banks had a lot of excess liquidity, got the system back on track, but at the same time they started reserving all of the excess funds that they have with the Federal Reserve. So the monetary base increased. Yeah, we looked at the monetary base. There are different M1, M2, M3. Yeah, so monetary base increased, and then the reserves of the Federal Reserve also increased. These banks, when they had this excess money, started reserving and parking that money in the bank. And so the way Federal Reserve acts through this monetary policy is through this corridor system. It has the federal funds rate, which is between the interest rate on the reserve and also the on rate, which is on RRP rate. So think about this as interest rate on the reserves is, think about how much money um, you as a bank or a financial institute can get from the Federal Reserve um, by parking your reserve. So let's say 5.5% is one example. This example is close to 1%, but let's say interest rate on reserve is what acts as the ceiling, and then we have the on RRP overnight reverse repo rate. This acts as the floor. Yeah, so this is the rate. You wouldn't lend if the Fed is willing to, be your lender for 5.25% to anyone else. Yeah, anything lower than 5.25% you won't take, and then you will at the safest you can get from the Fed is 5.5%. So these two corridors of interest on reserve as the ceiling and overnight reverse repo rate as the floor helps guide the Fed funds rate, which is somewhere in between. Yeah. And there's also this emergency lending facility with a discount rate, which it's a much higher rate than the interest rate on reserves, primarily because Fed doesn't want to encourage banks to keep going to the Federal Reserve for emergency lending, for, and they only want to do it during emergency times. So they should just go to and do interbank loans and from the market rather than use the Federal Reserve. There's also this discount rate that we have. So this Federal corridor is what's used when Federal Reserve decides to guide and change the federal funds rate. Okay? What we've also seen is that the federal funds rate is a really important conventional monetary policy, but there's also a need for these new tools needed, which are called as the macroprudential tools. These are the tools that were used, yeah, um, and can be used to extend the mandate of the Federal Reserve. Currently, it has two mandates: maximum employment, uh, maximum employment, yeah? And so stable employment and percent inflation target. But then, what if they start to notice that there's a lot of foreign currency based funds coming in and loans are being made in foreign currencies? And what if they start to see higher leverage in the banks? Should the Federal Reserve start to do something about it? Well, that's where a lot more things are needed so that they don't come to clean up the mess. There's a saying, better lean than clean, meaning they want to be proactive, right? So there are new tools that are needed so that the issues don't crop up. And this is a really good example chart that if we see the LTV ratio, loan to total value. So if you have a house of 100 bucks, can you get 100% of it? And you can get it in Ireland. You can even get much higher in Netherlands, but only 60% or so in Korea. Yeah. So you can have stability measures in the financial system applied through these new tools, new requirements to both the lender and to the borrower, yeah, so that you have the financial system that can be made stable. Should that be the reserve? Should that be the Federal Reserve's mandate, or should that stay with the Treasury? So these are the new set of tools that discussions are happening as to, because if you give those tools access to the Federal Reserve, then the Federal Reserve becomes way powerful, right? So there's this balance of power discussion as to how do we make sure in this case that there are certain capital requirements, that the risks don't add up on the financial side. And those countries, if we see anecdotally here, which had the stringent requirements on borrowing, had lower price increases. Yeah, so the y-axis shows how much is the price increase based on the LTV ratio. So lower the LTV, maximum LTV, the lower the price increase, meaning the booms didn't become pretty massive bubbles, and the busts also again will the downside will be protected for the busts as well. So now let's end with the COVID inflation and what happened and how Fed was clearly late. So look at this unemployment rate shoot up in a pretty big way, um, and that was primarily because of not the because primarily because of we were told to stay at home, and a lot of people did lose jobs because of that. But at the same time, look at the inflation actually improved quite a bit, close to um, well below the 2% target. And so the Federal Reserve didn't act until it was like all the way peaking, well past the 2%. So clearly, when they started acting, is well above 2% rate. So why were they late to the party? Yeah, even when they saw unemployment rate high and there was a huge amount of stimulus being added to the system after COVID crisis, but like, why is it that they were so late? Well, it's pretty clear that they were late, but they were late because of their projections and because of two guidances that they had given. And once they, pick a stance and not change it, that's also a problem. But credibility and picking a stand and staying is also good, but also bad. And this is how it backfired. If you see their projections were always for the few years out such that inflation was below 2%, below 2%, below 2%. And here is when they started anticipating that in the new year, in the year after, the inflation would be above 2%, above 2%. And then this is when they started realizing that their projections were also factoring in the fact that inflation is going to be above the 2% target. And so when inflation rose, and only when their forecasts started changing, because they realized that some of these things will not go away, inflation wouldn't just go away and subside on its own, which is what they were uh, anticipating in their models, and the forecasts were showing that. That's when they started acting. And when they started acting in terms of raising the interest rate, they acted quick. So that was good. But yeah, those were the two policy stances that they took, that the labor market should have reached a consistent level of maximum employment, and the inflation has risen clearly above 2%. But when it did, it went up like quite fast, and then it kept going up and up and up very quickly. Yeah. So that's what went wrong. So we went through and looked through the monetary policy, summing up, realizing that some of these crises have had these reassessment of what should be the mandate of the Federal Reserve. Is it including the macro, the macroprudential tools that we talked about here, impact on the lenders and the buyers, and some new rules for them, or is it purely about maximum employment and 2% target? And if so, is the 2% the right target? Uh, Currently, they have already made some changes in terms of wording, saying over time, right? 2% over time, right? And so, should that be 3%? But they are also worried that if they move up from 2 to 3, then inflation becomes unanchored. We saw that expectations is a huge part. And so they're also worried about not changing those expectations. So this is quite interesting. Yeah. Monetary policy summing up. This was the last chapter, I think, second last chapter. There's one more that gives us a worldview of how macroeconomics evolved over many, many years. So which we will cover at some point after this. Yeah. Thanks.